Well, as a mark-to-market trader, that position gets mark-to-market on December 31st. So whatever the price is on the last closing day of the trading day of the year, that's going to be your realized gain or loss that you have to report on your taxes.
Welcome back to the Cobra Trading Channel, everyone. Today, I have a very special guest. His name's Brian. He's from Trader Fyles. And you're probably thinking this year already about taxes. So we brought Brian in today to talk all about taxes and how to save money and how to be thinking when it comes to filing your taxes. So Brian, welcome to the show, brother.
Hey, thanks for having me. It's a pleasure, and I'm excited for our conversation today.
First up, I know a lot of people are probably asking themselves, like, how do I even know if I qualify to file my taxes as a day trader? So can you help people understand if they qualify to actually do something like this?
In order to qualify as a trader, you're going to want to grade yourself against kind of what the IRS guidance is. So if you look at IRS tax topic 429, you go through that verbatim, you really won't know because they don't telegraph what that criteria is. And so what we've done is we've looked at the actual criteria based on prior court cases, and we've created an acronym. I call it the BEHAVE test. That'll help you determine whether or not you qualify as a trader. So the B stands for business expenses that are reasonable and necessary to run a trading business. So you probably got software subscriptions, you've got locate fees, market data, things like that you're going to use to execute your trading strategy. So the E is going to be equipment used in trading. So a lot of you use things like super powerful computers, multiple monitor setups, laptops, things like that. So that's going to be your equipment. The H is going to be hours in the market. So you want to have somewhere between 4 to 5 hours on average in the market. So that's going to be both fundamental and technical analysis. So if you're doing things like reviewing SEC filings or reviewing charts, all that type of time is going to count towards your hour requirement. So the A is going to be your average holding periods. So you want to make sure on average your holding periods is less than 31 days. Now you can swing here and there, you can invest in positions, but on average your turn rate needs to be less than 31 days. And so the E is going to be, the second E is going to be the extent at which you trade. And so that's going to be basically, you want to make sure you have a trade on 75% of open market days. So as you guys know, the equities market is open 252 days in the year. So 75% of that is going to be the majority of those market days. So you got to have a trade on at least 189 days. And probably the easiest requirement for a lot of you is going to be the volume of trades of what you do. And so that's going to be 720. So we're going to look at both on the buy side and on the sell side.
Now, do you need to have a big account to even qualify? Like, do you need a certain amount? Like, because I know some people are trading actively, but they have like a small account. Maybe they're under 25K, but they're still active and still hitting these criteria. Can they still qualify?
So in most scenarios, I'm going to lean towards the no. And the reason why I say that is if you look at the extent at which you trade, so you got to trade 75% of market days. So that's almost 3 out of 4 days per week. And so if your account size is below the pattern day trader threshold of $25,000, it's going to be hard for you to execute significant volume just because you're going to be capped at the number of trades that you can execute in a 5-day rolling period. Now, I have seen scenarios where there's options traders where they have cash secured accounts or cash accounts where their trades will clear T+1. So when they trade T+1, that unsettled cash can be redeployed the next day. So you can actually trade every single day. But for the most part, I'm going to lead towards no for the guys that are specifically equities trader. Normally, you want to be over the PDT row.
Unless they have multiple accounts, right, that are under PDT? Or is it only in one account that they look at?
No, they look at multiple accounts. So it's any account that's tied towards either your social security number, or if you trade in an entity or an LLC, it's going to be tied to that.
And Roth IRAs do not qualify for anything around, because I know some people are probably like, well, I trade my Roth every single day. Can that help me save money? But I mean, for most people who don't know, you don't pay taxes on your Roth. So
exactly. So that's going to be the best tax strategy for you, right? Because you're not paying any tax on the growth in that account. But when it comes to qualifying as a business trader or trader status, you can't actually count those retirement trades. But if you've got enough money in there to execute your trading, then I would say that would be the best tax strategy outside of exploring other options.
Is there any advice you have for people, whether regardless of if they're making money or not, and they're pursuing this, like to help them better set themselves up to save money when it comes to trading as a business?
Yeah, I mean, I think that if you're not making money as a trader, no one gets into this business. You know better than I do, but no one gets into this business to lose money. But in the beginning, it's not uncommon for a startup business to incur costs, whether that's education, whether that's learning. The thing about being a trader, it's very unforgiving. If you make a mistake, you're going to feel it that day. Versus a different type of business, you might not necessarily get the ramifications or the consequences of making a mistake. So my advice would be understand what you're getting into before you get into it. So the first step is, okay, if I want to be an active trader, I need to understand what it means to be an active trader and how can I leverage the tax code to my favor. So as an active trader, you're going to get two main benefits. One is the ability to write off your business expenses. So locate fees, commissions, ACH wires in and out of your account. Then you're also going to be able to use what's called mark to market. So I don't know if we want to get into the weeds of that, but that's going to be something that you also get as a benefit. So to set yourself up for long-term success, you don't want to make any mistakes along the way. So I think it's a great idea to make sure you just, at least at a minimum, educate yourself.
And could you give us a brief description of what mark to market is?
Yeah, basically high level, what mark to market is, it's an accounting designation for how your trades are reported, by your broker. So right now, if you don't have that designation, then you're subject to what's called the wash sale rule. And so what the wash sale rule means is that anytime you buy and sell a stock within a 30-day window and you take a loss and you rebuy that position, that loss is disallowed for tax purposes and it's added to the cost basis of your very next trade. And so where this becomes a problem though is throughout the year, it's not a huge deal. Where it becomes a problem is when you're straddling 2 year end periods. So like, let's say you traded all the way through December and then you take some losses in December and then you rebuy those positions in January. All those losses that you took on those particular tickers are going to get carried into the next year. So in the current year, your income could be a lot higher just because you have losses that got pushed into the next year. And so what mark to market does is it really gets rid of all that accounting. So you're now on the realized gain loss method. So at the end of every day, whether you close that position or not, it's mark to market. So if you, let's say you have a position that's open on the, yeah, go ahead.
No, go ahead.
Okay. So whether or not, so if you have a position open on, let's say December 20th, and then you decide I'm going to roll this into the next year. Well, as a mark to market trader, that position gets marked to market on December 31st. So whatever the price is on the last closing day of the trading day of the year, that's going to be your realized gain or loss that you have to report on your taxes. So as a mark to market trader, there's no longer long-term capital gains. It's all short-term capital gains.
Can anyone, like, I'm just curious here because there's going to be some people who don't use direct access brokers and they use E-Trade, Fidelity. Is it easy to get mark to market qualify? I guess you just call and ask them, like, how does that work?
Yeah. So one is you want to make sure that whatever accountant or CPA or tax guy that you're working with, one is you want to make sure that that election and that documentation was filed correctly. And then once it's filed correctly, then you can request your broker to change your back office reporting. And so if they change your back office reporting, then they will report on your 1099-Bs, either mark to market accounting or your trade accounting with wash sales. And so that's where Trader Fyles comes into play, is because you're going to get all this data from your broker. And then the broker reporting requirements are completely different than what a taxpayer requirements are. So you're going to get all that data and you're going to need a software solution to help automate the capital gains reporting for you. And so that's where our software solution comes into play.
And we're going to dive deeper here in just a moment about what your software is to offer. And I know it's going to help a lot of people when it comes to filing their taxes. If they don't have someone to do it for them right now, maybe they want to do it themselves, take more advantage. But I wanted to ask a couple of things that I know people run into, especially in the year 2020, when it's a lot easier for the most part to make money. And that is two things. Number one, paying quarterly tax payments. Do you recommend that? And is that something that like people do? I just started doing that myself last year. Like, I hate doing it. I'd rather pay at the end of the year, but like, is there any like like, does it matter? Like, which one
I could
should you
definitely
do?
emphasize with that because that's a very popular question. So if you don't know, I'm also a CPA that I have a CPA firm that I run. I've got a lot of employees that kind of handle the day-to-day operations, but I still do get involved with some of the tax strategies. So I see all types of business owners, traders, e-com guys, dry shippers, influencers, create all that type of stuff, right? And so what I notice about a trading business, it is not as predictable as, like, let's say a brick and mortar, like a restaurant, where you can predict, kind of what your sales volume is going to be quarter over quarter, month over month. You can predict your profit margins. So based on that, the IRS basically says, hey, every single quarter, what you're going to want to do is you're going to want to send us your tax payments over 4 quarters instead of waiting until the end of the year. And if you wait until the end of the year, you're going to get hit with what's called an underpayment or estimated underpayment penalty. Sorry. But for a trader, that's really hard because Q1, you could make $150,000. And then if you write a check to Uncle Sam for, let's say, 50,000, and then next quarter you start trading again and you lose 150K. Well, in the back of your mind, you're like, well, why did I even pay it in the first place? Because I
Yeah.
lost the trading capital anyway. So in my experience, to answer your question, the correct answer is yes, you're supposed to pay quarterly. But in my experience, most traders wait until the end of the year when that year, December 31st hits. And they're like, yes, my year is set. I made X amount of money. Let me go ahead and fire the money off. Now they're going to get hit with an estimated underpayment penalty. But I always just tell them, look at it almost like a margin interest loan, where if you're trading on margin, you're paying your broker interest to use additional leverage or additional capital. Same situation. Now you're just using the IRS's money. Instead of paying them over a quarter, you're paying them at the end of the year for the chance to keep trading, to keep growing your accounts. And so on the end, you're just going to pay some penalties because you didn't pay those taxes. Hopefully that makes sense.
It does make sense. I'm glad I asked that because I know there's a lot of people who are going through that and they're like, man, what do I do? Do I do this? Do I do that? So, and you guys, I know you have your own YouTube channel, so you guys need to check out Brian's YouTube channel. He goes into a lot of different examples of questions you probably have right now while you're watching this, where he talks about benefits for traders. So you got to check it out. But also, I want to ask you this because I know traders who went through this. They made a lot of money.
Yeah.
And then they didn't do so hot the beginning of the first, year, whatever, but they didn't realize that they have to pay all of these taxes, right? So what if you can't pay? Like, what if, are there benefits? Like, on the benefits, is there things you can do to defer payments to help you pay? Because maybe you're in that situation where you just didn't expect it, you weren't aware.
Well, I think you got to treat trading like a business. So it's no different than any other business if you're treating this serious. And so if you're waiting to the very last minute to tax strategize, to tax plan, you're probably already behind the ball. You really need to make sure you're looking at this stuff month over month, quarter over quarter, year over year, right? Like your performance may change as the markets change, but you always need to be ahead of your tax strategy. And so if you're having a big year and you fail to plan and then you cross into a new year and let's say something happens and you lose all that money, well, if you didn't set that aside, you're going to be in trouble. So some of those options could be, you can do an offer in compromise. You can do a currently not collectible. You can do a streamlined installment agreement. So usually with a streamlined installment agreement, though, you need your balance has to be below $50,000. So if your balance is below $50,000, the IRS will allow you automatically to pay those taxes over 6 years. But again, I'm not a specialist when it comes to IRS tax resolution. We focus more on tax strategy.
Okay.
Tax compliance. And so I would definitely encourage if someone's out there that's watching this, that's having tax problems, that they really get with a resolution firm that can help explore those options.
I appreciate that, man. You at least shed some light on some terms that people can look up now to kind of get an understanding, because there are people who made a lot of money unexpectedly and spent a lot and then have a bill and be like, oh, I forgot. It happens. So
as a practitioner, I saw it a lot during the pandemic and then kind of that blow off after where, I would talk to some people. I have clients that are seasoned traders that, we talk year after year after year, but I saw some people where, I wouldn't call it beginner's luck, but I guess you can call it beginner's luck, where they made a lot of money unexpectedly, the GameStops, the AMCs, the Bed Bath and Beyonds, right? And my comment to them would be, look, if you're really a trader, if you're really good, wire down the money, set aside the money for taxes and redo it again. Do it again. Don't take 500 grand, go back all in on whatever and try and grow your account. My advice was just, hey, if you did it once, you could do it twice. Take the money out, pay yourself, invest in some other areas, and then do it again. But yeah, there was a lot of people that got hit with some rude awakenings.
Well, look, Brian, I want you to get the opportunity to share what Traderfyles exactly is. And if you don't mind, just explain how people could take advantage of it working through Cobra. I know you guys are offering a great offer.
Yeah. Trader's been a great partner of ours, and really appreciate it to, Chad, the whole team. Love what they do down there in Texas. But yeah, so Trader Fyles is basically a software solution that helps automate capital gains reporting for day traders, investors, and also tax professionals. So we do have a lot of tax professionals that are on our platform that help service their clients. And so how we do it is we do it in two ways. The first user experience is what we call the 1099B match. And what happens there is you'll get a document, say Cobra's your trader, you'll get a document that's a 1099B. And all you're going to do is if you don't do your taxes, you're probably going to send it off to your tax guy and he'll figure it out. But if you're someone that does it on your own, then you have to figure out how do you report these transactions on a form 8949 because the formats don't match. You could have multiple brokers as well. And so you have to report all that data on this tax form. And so what our software does is
It's not fun.
It's not fun. You can be in there keying for the next couple hours. So you upload that information to our software, and basically in a click of a button, in a few seconds anyway, you'll get your actual tax reports spit out. And so you can export that file and either give it to your CPA and they can go file the taxes, or if you use TurboTax, we have some integrations where you can upload our reports to TurboTax, so that way you don't have to key in
Oh, cool.
2,000 lines of data, which is one option. 1099B match. I would say majority of the people like that because it's fast, it's efficient, and it's easy to use. Now we have another user experience, what we call Audit My Broker. So this is where scenarios that happen where, let's just say you get a 1099B from your broker and it says, hey, I made $300,000. And you're like, I would love to make $300,000, but I don't know if that's actually correct. And so what our Audit My Broker feature does is it gives you an independent calculation of your gain and loss based on your trade history files. So you would go into your broker, you would export your Excel data, your CSV data. You'll format it so that way our software algorithm can read it, and you'll upload that data, and we'll spit out what your sales proceeds were, your cost basis, your wash sales, or if you're mark to market, we can also run the mark to market reports. But we'll spit out that information to say, hey, we think it's this. So if it's in line with what your broker is, then you know that they're reasonably accurate. But if it's completely off, then that opens up another conversation to say, hey, broker, I had an independent validation of my trade records, and I don't think this is accurate. Let's come to the table and you can start that discussion. So we found that was a valuable tool in areas where a broker could have made a mistake.
Interesting. So if someone wants to take advantage of the software right away, where do they need to go? What is there a coupon code or some type of code where they can get a deal?
Yeah, so they can go to traderfyles.com. And we'll drop the links here in the video and distribute it through the proper channels. But there will be a link. So for any Cobra clients, users, subscribers, we are affording them the opportunity for I think it's 50% off for this tax season. And so if you use the sign up code, the links, and all that good stuff, you'll be able to use our software this year at a discounted rate.
Perfect. Well, look, Brian, I appreciate you so much today, man, joining us and giving us some great insight on doing the worst thing that we hate to do, which is taxes. So thanks again, my man.
Yeah,
And
cool.
again, we appreciate you.
Absolutely. Thank you.